The Federal Deposit Insurance Corporation, the Federal Reserve Board, and the Office of the Comptroller of the Currency are pleased to present this overview of new regulations implementing the Community Reinvestment Act. The Community Reinvestment Act, or CRA, was adopted in 1977 and is one of several seminal laws enacted to address inequities in access to credit, including the Equal Credit Opportunity Act and the Fair Housing Act. The CRA is administered by the Federal Reserve Board, the FDIC, and the OCC. We'll simply refer to these as the agencies in this presentation. The CRA requires the agencies to assess a bank's record of meeting the credit needs of their entire communities, including low and moderate income communities, consistent with safe and sound operations. The agencies are responsible for issuing regulations on how banks are evaluated under the Community Reinvestment Act. Supplemented by supervisory guidance, the CRA regulations establish the framework and criteria by which the agencies assess a bank's record of meeting the credit needs of its entire community, including low and moderate income neighborhoods. On May 5th of 2022, the agencies released a Notice of Proposed Rulemaking to update and modernize the CRA regulations, and the agencies received approximately 950 unique comments, which were carefully reviewed and considered. The final rule was adopted by the three agencies on October 24, 2023. The rule has various important dates, which we will discuss at the end of this presentation. While there is a multi-year implementation timeline, the agencies have already begun the process of planning for additional training for banks and the public, including interagency examination procedures, examiner training, and important tools and resources for banks and examiners. So, more to come. Now let's discuss the final CRA rule. The agencies were guided by 8 objectives for modernizing the CRA rule, and we'll highlight several of them now. First, the final rule seeks to strengthen the achievement of the core purpose of the statute by encouraging banks to expand access to credit, investments, and basic banking services in low and moderate income communities, both rural and urban. For example, the new rule expands the geographic areas in which the agencies evaluate a bank's retail lending and the geographic areas where community development activities are counted. In addition, the final rule promotes financial inclusion by recognizing bank activities with minority depository institutions, community development financial institutions, and in high-need areas, including native lands and in persistent poverty areas. The second key objective involves adapting to changes in the banking industry, including the expanded role of online and mobile banking. This is the first major revision of the CRA regulations since 1995, before the widespread use of online and mobile banking. The final rule updates the CRA regulations to evaluate lending outside assessment areas based on bank facilities, with additional areas evaluated due to the growth of non-branch delivery systems, such as online and mobile banking, branchless banking, and hybrid models. This means that banks will be evaluated on their mortgage and small business lending, whether it's done from a branch or online. This is a business model neutral approach. The third objective is to provide greater clarity, consistency, and transparency in the CRA evaluation, which stakeholders across the spectrum have asked for. One way the final rule accomplishes this is by using metrics as part of the approach to evaluating bank retail lending, community development financing, and employs benchmarks based on market and community data. Another way the rule offers greater clarity and consistency is by more clearly defining community development activities, such as affordable housing. The final rule also tailors the CRA evaluation and data collection requirements to the size and business type of the bank. Similar to the bank size categories under current rules, most banks will be evaluated under the final rule as either small banks, intermediate banks, or large banks. The final rule retains a limited purpose category and the strategic plan option. The final rule tailors the tests and data collection to each of those categories. For instance, there are no new data collection requirements for small or intermediate banks, and the agency sought to leverage existing data as much as possible. The final objective that we will highlight is promoting a consistent regulatory approach that applies to banks regulated by all three agencies. Not only did all three agencies work together to adopt this rule, but they also will work together in its upcoming implementation. These next few slides move from the basic architecture of the current rule to the final rule's evaluation frameworks. For clarity, we will refer to the current rule in this presentation. We are referring to the regulation in effect prior to the applicability dates of the final rule, which was approved on October 24th of 2023. In the current rule, institutions are evaluated under different CRA examination procedures based on the asset size or business model of the institution. Large bank exam procedures include an analysis under three separate tests: the lending, investments, and services tests. The lending test includes both a retail lending component and a community development component. And the service test includes both retail banking services and community development services. Intermediate small banks are evaluated under the small bank lending and community development tests. Small banks are evaluated under the lending test for small banks with the optional consideration of investments and services. Wholesale and limited purpose banks are evaluated under a community development test for wholesale and limited purpose banks. The chart on this slide summarizes the evaluation approach under the new rule for all bank types, apart from those banks that elect to be evaluated under an approved strategic plan. This tailored evaluation framework also utilizes different performance tests to assess banks of different asset sizes and business models. Compared to the current framework, the final rule retains the three bank asset size categories, but we increase the asset thresholds at which a bank moves from one category to the next. Effective January 1st, 2024, institutions with assets of at least $1.564 billion are considered large banks. This threshold will be increased to $2 billion under the final rule on January 1st, 2026. Under the final rule, 4 performance tests will be applied to large banks: the retail lending test, the retail services and products tests, the community development financing test, and the community development services tests. Each test focuses on activities that advance financial inclusion in low and moderate income communities and to low and moderate income individuals. Currently, banks with assets from $391 million to less than $1.564 billion are considered intermediate small banks. We renamed the category intermediate banks and increased the asset size range to $600 million to less than $2 billion in assets. Intermediate banks will be evaluated under the retail lending test and the community development test that is currently applicable to intermediate small banks, unless they opt to be evaluated under the new community development financing test. Currently, the asset size threshold for a small bank is less than $391 million. This threshold is revised to assets of less than $600 million in the final rule. Small banks will continue to be evaluated under the existing small bank performance standards, unless the bank opts into the new retail lending test. In addition, small banks may elect to have their retail services or community development activities evaluated to enhance their performance evaluation and rating, but these activities are not required. The final rule also retains the limited purpose designation. However, this designation now consolidates the former wholesale and limited purpose designations. Limited purpose banks will be evaluated under the Community Development Financing Test for limited purpose banks. As with the existing CRA rule, banks will still be able to submit a strategic plan to their regulator for review and approval. However, the final rule makes some changes to the strategic plan requirements.
Assessment areas are the primary areas in which banks are assessed on their CRA performance. Under the existing regulation, banks are evaluated in assessment areas identified by where they have a main office, branches, and deposit-taking ATMs. Our goal with the final rule was to take a both-and approach to evaluating banks, both where they have branches as well as where they are lending or engaged in other relevant activities outside of their branch networks. This approach takes into account changes in the banking landscape over time with the rise of mobile and online banking and ensures a comprehensive evaluation of a bank's activities. The final rule retains the requirement to delineate assessment areas around main offices and branches, as well as deposit-taking remote service facilities, which includes ATMs. These are called facility-based assessment areas. Large banks and limited-purpose banks are required to delineate facility-based assessment areas consisting of one or more contiguous counties within an MSA, or one or more contiguous counties within the non-metropolitan area of a state. For intermediate banks and small banks, however, the rule provides these banks with greater flexibility and allows them to delineate partial county facility-based assessment areas. This is consistent with current practice and recognizes their smaller service areas. Also, like today, facility-based assessment area delineation must not reflect discrimination and must not arbitrarily exclude low or moderate income tracts. For facility-based assessment areas, all applicable performance tests will be applied when conducting the bank's CRA evaluation. For example, large banks will be evaluated on all 4 tests in each facility-based assessment area. Outside of their facility-based assessment areas, the final rule requires large banks to delineate retail lending assessment areas where a bank has concentrations of closed-end home mortgage and or small business lending. Under the final rule, a large bank must delineate a retail lending assessment area in each geographic area where it originated at least 150 closed-end home mortgage loans or at least 400 small business loans that are reported in each year of the prior 2 calendar years. These geographic areas include MSAs, or non-metropolitan areas of a state, excluding counties that are part of the bank's facility-based assessment areas. For retail lending assessment areas in non-metropolitan areas of a state, counties are excluded if the bank did not originate any closed-end home mortgage loans or small business loans that are reported loans during that calendar year. Recognizing that some banks continue to do most of their lending where they have a branch presence, the final rule includes an exemption from the retail lending assessment area requirement for large banks that conduct more than 80% of their retail lending in facility-based assessment areas. Intermediate and small banks are not required to delineate retail lending assessment areas. It's important to note that for any large bank with a delineated retail lending assessment area for an evaluation year, only the loan products that trigger the delineation are evaluated that year. This would include closed-end home mortgage loans or small business loans or both. No other type of retail loans are evaluated in a retail lending assessment area under the retail lending test, and no other performance tests apply. Second, in the final rule, the agencies evaluate a bank's retail lending conducted outside the bank's facility-based assessment areas and retail lending assessment areas. This area is described as the outside retail lending area, or ORLA, as we sometimes refer to it. As we will discuss in a moment, lending evaluated in the outside retail lending area must meet a 15% major product line standard. That is, the bank's loans in a particular product line comprise 15% or more of all of the bank's loans across all product lines in the facility-based assessment area or outside retail lending area. For intermediate banks and small banks that opt into the retail lending test, lending in their ORLA is evaluated when more than 50% of their retail lending is outside of facility-based assessment areas. For intermediate banks and small banks opting into the retail lending test that do not meet this threshold, these banks also have the option to have their retail lending evaluated in their outside retail lending area. Also noted on this slide, the final rule clarifies the areas where a bank is evaluated on their community development performance. The agencies will consider all community development qualifying activities regardless of location. This will provide greater certainty and recognize many community development lending, investment, and service opportunities in rural and other underserved areas. Community development loans, investments, and services conducted outside of facility-based assessment areas are considered at the state, multi-state MSA, and at the institution levels as applicable. The final rule responds to stakeholder feedback about improving transparency and certainty about the community development activities that are eligible for CRA credit. One key part of the rule is the establishment of standards that clarify when banks will receive full or partial credit for a community development loan, investment, or service. The standards include 1. A majority standard, which generally considers whether a majority of dollars, beneficiaries, or housing units go to one of the enumerated community development categories, or 2. In cases where the majority standard is not met because, for example, such data is not readily available, banks could still get full credit for activities that have the express bona fide intent of community development. 3. Banks will also get full credit for activities associated with low-income housing tax credit, affordable housing programs, or those activities that are conducted in conjunction with minority depository institutions, women's depository institutions, low-income credit unions, and Treasury Department Certified Community Development Financial Institutions, or CDFIs. 4. Finally, similar to the current rule, partial or pro rata credit is provided for mixed-income rental housing that provides affordable units in conjunction with a government program. For additional clarity, the agencies will maintain and periodically update a publicly available illustrative list of qualified community development activities. In addition, the agencies will develop a process for banks to confirm the eligibility of community development activities in advance. As you're aware, the definition of community development under the current rule contains 4 categories. Under the new rule, the agencies have expanded the current definition of community development to include 11 categories. The new categories generally build upon the current definition of community development and incorporate certain existing guidance into the regulation in order to provide more clarity and certainty regarding the types of activities that will be considered community development. Here, we will highlight a few provisions included in these categories. First, the final rule retains a category for affordable housing activities. Specifically, the categories include 5 different components of affordable housing. The first component is rental housing in conjunction with a government affordable housing plan, program initiative, tax credit, or subsidy. Qualification under this component of the final rule includes, for example, activities with rental properties receiving low-income housing tax credits or subsidized by government programs that provide affordable rental housing for low or moderate income individuals, such as project-based Section 8 rental assistance and the Home Investment Partnerships Program. Second, affordable housing includes multifamily rental housing with affordable rents or naturally occurring affordable housing. The final rule provides clear standards for when this type of multifamily rental housing that does not involve a government program will be considered. The affordable housing category also includes 1 to 4 family rental housing with affordable rents in non-metropolitan areas and activities that support affordable owner-occupied housing for low or moderate income individuals. Finally, mortgage-backed securities are included under this category if a majority of the underlying loans finance affordable housing for low and moderate income individuals and meet certain standards. The new rule also updates the economic development category to include 3 distinct components. First, economic development includes loans, investments, and services undertaken in conjunction or syndication with government programs with 2 distinct subcomponents. Under this subcomponent, activities may support small businesses or small farms as defined by the applicable government program, plan, or initiative, or that support small businesses and small farms, which are defined in the final rule as businesses with gross annual revenue of $5 million or less. Activities with small business investment companies, certified community development entities, and rural business investment companies would be presumed to qualify under this component. The second subcomponent includes certain direct loans to small businesses and small farms in conjunction or in syndication with government programs that meet a size and purpose tests that are similar to the current regulation. To meet the size eligibility standard, the loans must be to businesses and farms that meet the size eligibility standards of the Small Business Development Center or the Small Business Investment Company programs, or that meet the definition of small business or small farm noted previously. To meet the purpose test, the loans must have the purpose of promoting permanent job creation or job retention for low or moderate income individuals or in low or moderate income census tracts. For example, SBA 504 loans will qualify under the direct lending component. Economic development also includes loans, investments, and services provided to intermediaries and other forms of assistance to small businesses and small farms. The final rule replaces the current revitalization and stabilization activities component of the community development definition with 6 new place-based categories of community development activities. 4 of the place-based categories focus on low and moderate income areas and distressed or underserved non-metropolitan middle-income census tracts, including activities related to revitalization and stabilization, essential facilities, and essential infrastructure. This category also includes disaster recovery activities in designated disaster areas. The place-based categories include 2 new categories of activities, including disaster preparedness and weather resiliency, which covers activities to help individuals and communities prepare for, adapt to, and withstand natural disasters or weather-related risks or disasters. The other new category is activities in native land areas. The provisions in this category reflect the unique economic, credit, and financial service needs of Native and tribal communities. All of these categories specify that eligible activities must benefit or serve residents, including low or moderate income individuals, and may not directly result in the forced or involuntary relocation of low or moderate income residents in the targeted census tracts or other specified areas. Lastly, of note, is a category providing community development credits for activities with minority depository institutions, women depository institutions, low-income credit unions, and CDFIs. The agencies established a set of impact and responsiveness factors in the final rule that will inform the qualitative review for the community development financing and community development services tests, as well as the community development test for limited purpose banks. These factors help to identify loans, investments, and services that are especially impactful and responsive to community needs. Some examples include activities that serve persistent poverty counties and other high poverty areas, activities that support small businesses or small farms with gross annual revenue of $250,000 or less, investments in projects financed by low-income housing tax credit and New Markets tax credit programs, and activities that support minority depository institutions, women depository institutions, low-income credit unions, or CDFIs.
The next few slides provide details on the performance tests. As you can see, the product lines evaluated under the retail lending test are limited to 4: closed-end home mortgage loans, small business loans, small farm loans, and automobile loans for a bank in which that loan product represents a majority of the bank's lending, or if a bank opts for it to be considered. Closed-end home mortgage loans, small business loans, and small farm loans must also meet a major product line threshold to be evaluated under the retail lending test. As mentioned earlier, the major product line threshold is 15% or more of the bank's loans across all product lines in the facility-based assessment area or outside retail lending area. We should note a few additional points about small business and small farm loans. Under the current approach, call report data definitions and data requirements are based on the size of the loan and not gross annual revenues of the businesses or farms. More specifically, the lending data is limited to loans in an amount of $1 million or less to businesses and loans of $500,000 or less to farms. And these reported loans are not subject to any limitation on the size of the business or farm. Under the final rule, the agencies are maintaining call report definitions of small business loan and small farm loan until the agencies transition to using Section 1071 data in CRA evaluations. The final rule establishes a set of retail lending metrics and benchmarks to evaluate a bank's retail lending. The first metric is the retail lending volume screen. It measures the dollar volume of a bank's retail lending in its facility-based assessment area relative to its deposits over the years in the evaluation period. This calculation includes originations and purchases of home mortgage loans, multifamily loans, small business loans, small farm loans, and automobile loans for banks in which automobile lending is a product line. The second set of metrics are applied to each of a bank's product lines and evaluates the geographic distribution of loans by evaluating the bank's percentage of loans in low and moderate income census tracts. The metrics will also evaluate the borrower distribution, which is the percentage of loans to low and moderate income borrowers, as well as to small businesses and small farms of different sizes. For small business and small farm lending under the borrower distribution, the agencies are adding an evaluation of the distribution of loans to businesses or farms with gross annual revenues of $250,000 or less, and loans to businesses or farms with gross annual revenues of greater than $250,000, but less than or equal to $1 million. Another general point to note here, the low-income and moderate-income categories are analyzed separately under the metrics approach. Each of a bank's distribution metrics will be compared to two sets of benchmarks. market benchmarks, which represent the aggregate performance of other reporting lenders in a geographic area during the time of the bank's evaluation, and community benchmarks, which reflect local demographic information, such as the percentage of low-income families in a facility-based assessment area. Together, these benchmarks are intended to reflect the lending needs and opportunities in an area. For each product line category, a bank's performance is then translated into a conclusion using performance ranges and thresholds that establish the level of performance needed to achieve a particular conclusion. For example, the percentage of mortgage lending to moderate income borrowers that corresponds with a high satisfactory. This is a change from current evaluations, which do not provide formal guidelines on the percentage of lending that generally corresponds with different levels of performance. The local community and market benchmarks form the basis of the performance ranges and performance thresholds, which allows for a tailored approach to each retail lending test area. In summary, the retail lending test provides a bank with greater consistency and transparency about CRA performance expectations. It tailors expectations to the unique conditions in different markets and automatically adjusts performance thresholds over time in a way that reflects changes in business and economic cycles. As a whole, the retail lending test provides greater transparency for banks and the public. In terms of the role that qualitative factors in performance context play, the final rule provides that when evaluating a bank's retail lending, the agencies will consider qualitative factors, such as a bank's business model and information about the community that is not already captured in the metrics. Thus, performance conclusions will not be based on metrics and benchmarks alone. The retail lending test conclusions for each state will be based on the weighted average of the bank's performance in each facility-based assessment area in the state and retail lending assessment area in the state. For institution-level conclusions, the agencies will take the weighted average of the bank's performance in each facility-based assessment area, each retail lending assessment area, and the outside retail lending area. Turning next to the Retail Services and Products test. This test has two prongs: retail banking services and retail banking products. This test evaluates the availability and responsiveness of a bank's retail banking services and retail banking products targeted to low and moderate income individuals, families, or households, low and moderate income census tracts, small businesses, and small farms. While the evaluation continues to be predominantly qualitative in nature, it also incorporates some quantitative measures as guidelines. Building on current practice, under the retail banking services prong, the agencies evaluate bank delivery systems, starting with the branch availability component. This evaluates the geographic distribution of a bank's branches in each facility-based assessment area compared to the geographic distribution of census tracts, households, businesses, and branches of other banks. The branch availability component continues to consider a bank's record of opening and closing branch offices, the reasonableness of branch hours, and the range of services provided at branches across census tracts of different income levels. The final rule also provides qualitative consideration for branch facilities in areas such as underserved and distressed non-metropolitan middle-income census tracts and native land areas. The second component of the retail banking services prong evaluates the availability and distribution of remote service facilities. The definition of remote service facilities captures ATMs and other deposit-taking facilities, such as interactive or virtual ATMs, where customers can connect with bank staff through a terminal. Like the branch distribution analysis, this evaluation uses benchmarks to complement the qualitative analysis and considers remote service facilities in other geographic areas. The third component of the retail banking services prong evaluates a bank's digital delivery systems and other delivery systems, and is required only for large banks with assets of more than $10 billion and large banks that do not operate branches. These delivery systems include, but are not limited to, mobile and online banking. Banks with assets of $10 billion or less with branches will have an option to be evaluated for digital and other delivery systems for additional consideration. Under the retail banking products prong of the retail services and products test, examiners will qualitatively evaluate a bank's efforts to offer credit products that are responsive to the needs of low and moderate income consumers and communities, small businesses, and small farms. Responsive credit products and programs may include, for example, those that facilitate home mortgage and consumer lending targeted to low or moderate income borrowers, meet the needs of small businesses and small farms, including small businesses and small farms with gross annual revenues of $250,000 or less, are conducted in cooperation with minority depository institutions, women depository institutions, low-income credit unions, and Treasury Department certified CDFIs, are low-cost education loans, or are special purpose credit programs. Also under the retail banking products prong, large banks with assets more than $10 billion will have deposit products responsive to the needs of low and moderate income individuals reviewed. This would include accounts certified by the Cities for Financial Empowerment as meeting the Bank on National Account Standard, and savings accounts targeted toward low or moderate income individuals, families, or households. Importantly, the evaluation of responsive retail banking products may only contribute positively to the retail services and products test conclusion. This review is optional for other banks. When assessing performance under the retail services and products test, branch availability, branch-based services, and the availability of remote services facilities is analyzed at the facility-based assessment area level. The third component of the retail banking services prong, digital delivery systems and other delivery systems, as well as the retail banking products prong, is evaluated at the institution level.
Now we're going to shift our discussion to the Community Development Financing Test. This test uses metrics and benchmarks to standardize the review of community development loans and investments, while also incorporating a qualitative impact and responsiveness review of community development financing activities. The agencies evaluate community development loans and investments in facility-based assessment areas, plus state, multi-state MSAs, and nationwide areas. Banks receive consideration for qualifying activities anywhere in a state or multi-state MSA in which they maintain a facility-based assessment area. In addition, banks receive consideration at the institution level for any qualifying community development activities conducted. The various community development financing metrics are used to evaluate the dollar volume of a bank's community development loans and investments relative to the dollar volume of deposits. The combined evaluation of community development loans and investments will provide banks with the flexibility to focus on community development financing methods most consistent with their expertise and to provide the type of financing that is most needed for a particular community development project. In addition, the agencies will count both new originations, purchases, and increased balances, as well as prior loans and investments remaining on the bank's balance sheet in the numerator of the metric in order to emphasize the provision of patient long-term capital. A community development investment metric and benchmark were included in the Community Development Financing Test for banks with more than $10 billion in assets. The metric and benchmark will measure community development investments, such as low-income housing tax credit and new markets tax credit program investments, and may contribute positively to a bank's nationwide conclusion. Limited purpose banks are evaluated under the Community Development Financing Test for limited purpose banks. Similar to the Large Bank Community Development Financing Test, the Community Development Financing Test for limited purpose banks includes community development financing metrics that measures the dollar volume of a bank's community development loans and community development investments together. However, for the Community Development Financing Test for limited purpose banks, community development loans and investments are measured against the bank's assets as opposed to its deposits. In determining the conclusion for the community development financing test at the facility-based assessment area level, examiners will consider the applicable metrics and benchmarks, the extent to which the bank's activity was impactful and responsive, and the relevant performance context of the facility-based assessment area. In determining the conclusions for the community development financing test at the state, multi-state MSA, and nationwide level, examiners will consider two components. Under Component 1, examiners consider the weighted average of facility-based assessment area performance using deposits and a combination of retail loan dollars and loan count. And under Component 2, examiners consider the applicable metrics and benchmarks, the extent to which the bank's activity was impactful and responsive, and the relevant performance context for the state, multi-state MSA, or the nationwide level. The Community Development Services test evaluates the extent to which a large bank operates community development services in its facility-based assessment areas and at the applicable state, multi-state MSA, and nationwide levels. The evaluation is primarily qualitative and is based on any relevant information provided by a bank, including information such as the number of community development services attributable to each type of community development criteria, the capabilities in which the bank representative served, such as a board member of a nonprofit or in a technical assistance role, and the total number of hours for all community development services performed by the bank. The evaluation also considers an impact and responsiveness review of services that are high impact or especially responsive to community needs. In addition, the final rule maintains the existing requirement that community development services must be related to financial services or the expertise of bank staff.
The next several slides focus on ratings. The final rule provides greater transparency and consistency on assigning conclusions and ratings for a bank's overall performance that is grounded in performance in its communities. Under the final rule's methodology, each performance test results in a performance score and conclusion at the state, multi-state MSA, and institution level. These performance scores are combined using a weighted average approach, with the value resulting from this calculation translated into the rating for the respective state, multi-state MSA, or institution. With respect to conclusions, the agencies maintained the current 5 categories of outstanding, high satisfactory, low satisfactory, needs to improve, and substantial noncompliance. For ratings, the agencies assign one of the statutory ratings of outstanding, satisfactory, needs to improve, or substantial noncompliance. For large banks, the agencies determine a bank's state, multi-state MSA, and institution rating by combining the bank's performance scores across all 4 performance tests. The agencies maintain the emphasis on retail lending and community development financing by giving these tests the heaviest weights. The final rule provides a weight of 40% each for the retail lending test and community development financing test performance scores. The retail services and products test and community development services test performance scores account for 10% each. In addition to the weighting of the performance tests, the rule requires that, as applicable, for each state and multi-state MSA and at the institution level, the retail lending test conclusion for a large or intermediate bank needs to be at least low satisfactory in order for the bank's overall rating to be satisfactory or higher. Also, The agencies imposed an additional restriction on state, multi-state MSA, and institution-level ratings for the large banks with 10 or more assessment areas in a state, a multi-state MSA, or overall. A large bank with 10 or more assessment areas, including facility-based assessment areas and retail lending assessment areas, will not be eligible to receive a satisfactory or higher rating unless it's achieved an overall performance conclusion of low satisfactory or better in at least 60% of its assessment areas. For the first examination under the new rule, this restriction will only include facility-based assessment areas. That is, it will only apply to banks with 10 or more facility-based assessment areas. Retail lending assessment areas will be considered in subsequent examinations. The agencies established this modification to the ratings approach to ensure that large banks receiving a satisfactory rating are meeting the credit needs of their entire community, and not just markets with higher levels of lending and deposits that factor more heavily into the weighted average conclusion roll-ups. In this way, overall ratings reflect performance in a broader set of markets served by the large bank. This performance provides an opportunity to large banks to meet the needs of rural and smaller MSA assessment areas that might otherwise be overlooked as insignificant. For intermediate banks, the agencies weight both the retail lending test and the applicable community development test at 50% each, consistent with current requirements. However, an intermediate bank needs to receive at least a low satisfactory on the retail lending test in order to receive an overall satisfactory at the corresponding state, multi-state MSA, or institution level. The agencies are not applying the current requirement that an intermediate bank must receive a satisfactory rating in the Intermediate Bank Community Development Evaluation. Small banks are evaluated using the status quo small bank lending test, so their rating continues to be based on the lending test performance. Small banks can receive an outstanding rating based solely on retail lending performance. Both small banks and intermediate banks have the option to request and may receive additional consideration for certain activities to potentially adjust a rating of satisfactory to outstanding at the institution level. Small banks can request consideration of retail services, community development investments, and community development services. Intermediate banks can request consideration for activities that would qualify under the Retail Services and Products test. If the intermediate bank opts to be evaluated under the Community Development Financing test, the bank can also request consideration for activities that would qualify under the Community Development Services test. Intermediate banks and small banks can also request consideration for providing low-cost education loans to low-income borrowers, regardless of the bank's overall institution rating.
Finally, we turn our attention to data collection and reporting, which is covered in the next several slides. The agencies recognize the importance of using existing data sources where possible and of tailoring data requirements based on bank size. Under the final rule, small and intermediate banks do not have any new data requirements for the required performance tests. For banks with assets over $10 billion, the agencies established new collection and reporting requirements for deposits data, which include the volume of deposits in the bank aggregated at the county level based on the location of the depositor. Other banks may choose to collect, maintain, and report deposits data. These reported deposits data will be used in calculations in the retail lending and community development financing tests and as part of the weighting calculation for aggregating performance scores. FDIC summary of deposits data will be used for banks with assets of $10 billion or less that do not elect to voluntarily collect, maintain, and report their deposits data based on depositor location. For some such banks, it will be in their interest to opt to collect and report deposits data, since there will be concentrations of deposits in facility-based assessment areas for banks where SOD data is used, which may not be representative of where the bank focuses its lending. In addition, large banks are required to report the delineation of facility-based assessment areas and retail lending assessment areas if applicable. Limited-purpose banks that meet the asset size criteria for large banks are also required to report the delineation of facility-based assessment areas. For retail lending, the final rule mostly relies on similar retail lending data to what is used today. Two notable additions to data requirements are, compared to small business and small farm loans data collected today, large banks will have added indicators to flag loans to businesses and farms with gross annual revenues of $250,000 or less, and with gross annual revenues between $250,000 and $1 million. Large banks for which automobile loans constitute the majority of their retail lending originations, or which opt to have their automobile lending evaluated under the retail lending test, are required to collect and maintain data on their automobile loans, including income level and census tract for each loan. The agencies expect this requirement to impact very few large banks. Regarding mortgage lending, the final rule includes language to close some coverage gaps in the Home Mortgage Disclosure Act, or HMDA, reporting requirements. Large banks that are HMDA reporters are required to collect and maintain the location of each home mortgage loan application, origination, or purchase outside the MSAs in which the bank has a home or branch office, or outside any MSA, as required under the current rule. Large banks that are not HMDA reporters due to the location of their branches, but would otherwise meet the lending activity requirements for HMDA reporting, are required to collect and maintain certain data on closed-end mortgage loans originated or purchased during the evaluation period. These data include a small subset of the data field that would be required under HMDA, but are sufficient to evaluate home mortgage lending for these large banks. Regarding retail services and products, large banks are required to collect and maintain data to support the final rule's branch analysis and remote service facilities analysis in a prescribed format. In addition, large banks with assets over $10 billion, large banks that do not maintain branches, and other large banks that request consideration of their digital and other delivery systems have new data requirements for digital and other delivery systems. This facilitates a review of the largest banks and digital banks' performance regarding whether digital and other delivery systems are reaching low and moderate income individuals and communities. Also, large banks with assets over $10 billion and other large banks that request consideration of their responsive deposit products are required to collect and maintain data on deposit products like low-cost bank accounts that are responsive to the needs of low and moderate income individuals and communities. The final rule requires all large banks and similarly sized limited-purpose banks to collect, maintain, and report community development financing data. The community development financing data is necessary to construct community development financing metrics and benchmarks used to consistently evaluate the dollar amount of a bank's community development lending and investments. The agencies also require that large banks collect and maintain community development services data in a prescribed format or a format of their own choosing.
Although the effective date of the final rule is April 1, 2024, only a few of the requirements are applicable on that date. Most new requirements will become applicable on January 1, 2026. Specifically, new definitions, the increased size thresholds, the new performance tests, and the data collection and maintenance requirements, as well as appendices A through F, are applicable beginning January 1, 2026. Banks will have until January 1, 2027 to comply with data reporting requirements every April 1, beginning in 2027. For agency-approved strategic plans submitted to and determined by the agency to be completed plans prior to November 1, 2025, They will remain in effect until the expiration date of the plan. Regarding 1071, the agencies are not including an effective date for these Section 1071 related transition amendments in the final rule. Instead, once the availability of Section 1071 data is clarified, the agencies will take steps to provide appropriate notice in the Federal Register of the effective date of the transition amendments. The agencies expect that the effective date will be on January 1st of the relevant year to align with the final rule's data collection and reporting, benchmark calculations, and performance analysis, which are all based on whole calendar years. Now we would like to discuss the provisions that are planned to go into effect on April 1st, 2024. First, Section 16, Facility-Based Assessment Areas. With few exceptions, the requirements are mostly the same as the assessment area requirements under the current rule. Some notable differences include large banks and limited-purpose banks are required to delineate full counties. A small and intermediate bank may continue to adjust the boundaries of its facility-based assessment areas to include only the portion of a county that it reasonably can be expected to serve. A bank may not delineate a facility-based assessment area that extends beyond an MSA boundary, and a bank may not delineate a facility-based assessment area that extends beyond a state boundary, unless the facility-based assessment area is located in a multi-state MSA. Section 31, Effect of CRA Performance and Applications. There are no substantive changes in this section from the current rule. Section 43, Content and Availability of Public File. The major change to this section from the current rule to the new rule is the requirement for banks to maintain on their website all information required for the bank's public file, if the bank maintains a website. This provision applies to banks of all size. In addition, there are now requirements to update certain information in the public file on a quarterly basis, including public comments and branch openings and closings. Section 44, Public Notice by Banks. This is an important clarification. Although this section is applicable on April 1, 2024, banks will not need to use the revised public notice in Appendix F until January 1, 2026. Until then, banks may continue to use the existing public notice found in Appendix B of Appendix G. Section 45, Publication of Planned Examination Schedule, and Section 46, Public Engagement, do not impose any requirements on the banks, but instead cover agency requirements. Lastly, we want to highlight future plans in 2024, where the agencies will further discuss the new CRA rule. First, there is the National Interagency Community Reinvestment Conference in March in Portland, Oregon. We encourage you to attend, and registration is currently open. In addition, we anticipate offering webinars and other outreach through 2024 that will consist of a deeper dive into specific areas of the regulation. For example, expect additional webinars soon on topics such as the transition and the April 1st, 2024 provisions, assessment areas, the retail lending test, and data requirements. Other webinars will follow throughout 2024. So please stay tuned, and we thank you for your attention.